So a couple more pieces on the employment equity side. One is that you need to keep in mind the tax consequences for the employees of receiving employee equity, and you want to make that process as friendly as possible to the employees. And so if you're in an LLC that's a tax flow through, you have the option to issue what are called profits interest. That can be very tax efficient ways for an employee to become an owner of the company when they receive those options, and that yet they remain subject to all of the same vesting restrictions and other limitations that you would have if you held stock options. If you're in a C corporation, you're working with stock options.
The other option, the other type of equity could be restricted share units or restricted shares. One of the issues that you have with restricted shares or RSUs is that they are taxable upon their grant. And so that creates, that, as Jeff was saying, you need to make sure that the employees understand what they're getting and what they're getting in terms of a tax consequence. Because in some small non-public entities, getting an RSU sometimes or restricted shares can be seen as a burden more than a benefit. And the whole purpose of granting equity to the employees is to make them feel like they're part owners, to make them aligned with the company and with the founders, and you're supposed to be rewarding them, not punishing them. So restricted share units, sometimes you hold those off until such time as it's a public entity, because at that point they can be sold on an open market. When you're a private company, there's many restrictions, including your stockholder or equity holders agreement, that's going to prevent you from selling these things. So you're just going to be taxed on them. In order to avoid the tax, as Jeff said, options tend to be the way to go.
They're the most common, and an option is a right to purchase stock in the future. And so typically for a corporation, employees will receive stock options that will allow them to buy stock for a period of up to 10 years. They will be subject to vesting restrictions that we'll talk about a bit more, but they will also allow the employee not to spend money, not to put money into the company, but to wait and see how the company does, and potentially to either sell their options into a sale transaction or to exercise their options and pay for the stock, and so that they can own the shares at that point in time. The exercise price for the shares needs to be set at a fair market value, and we don't need to get too deeply into that, but companies need to be very conscious that they don't give away equity at a below market price in these various structures. And so you can work with your attorneys and your accountants to make sure that you're doing it appropriately so that you're not creating undue consequences. Occasionally in a private company, as opposed to a restricted stock grant that Doug was talking about, you will actually have a key officer who wants to acquire shares in the company to buy them, and you can help them to do that in a tax efficient way at times. It's typically a bit more complicated, so it's sort of reserved for really truly key employees, almost founder type level employees, but you can help key employees out in that fashion.
And I think the other thing to note about stock options is, as Jeff said, there's an exercise price that will be set, but that's set at a given time. So if you get awarded options in January of 2021, and then you're due to get more in January of 2022, those exercise prices likely should be different. Now, it's a private company. You're hoping that they're always going up because that's the trend that you want, but the board would need to do a fair market assessment at each point.
Yeah. And so we talked a bit about vesting, and vesting is a set of restrictions that allows the company to retake the equity if the vesting requirements are not met. And Doug mentioned earlier that vesting is typically a time vesting structure, that shares will vest over a period of 3 to 5 years, often 4 years. and they base just on the passage of time and the employee continuing to do work for the company. And that's designed to keep the employee motivated through that period of time. Typically, you may have cliff vesting, meaning that an employee will not get any vested shares in the first 12 months of their employment. So that if someone comes on board, receives a grant of options, but then leaves in 3 months or 6 months, they won't walk away with a chunk of the company. After a year, you would have a significant vesting event where they would vest into, say, a quarter of their options or profits interest. And after that, they would probably vest on a monthly or quarterly basis, so more regularly. The other type of vesting that is used sometimes, less frequently, but at times it can be effective, is performance vesting. And that can be based on all sorts of performance hurdles. It can be based on a company gaining a regulatory approval for its medical device, having its first sales of the product, and there can be various triggers that key employees who are hired with a specific task will have their shares, their equity vest when that task is completed. The other type of performance vesting is investor return vesting. You see this used in private equity structures quite frequently, where the private equity fund will say to the management team, okay, we want you guys to have a large piece of the ownership, but your equity is only going to invest after we've received our money back plus a particular return or 2 times our money. And sometimes you can have sort of graduated vesting where more and more equity will vest into the management's hands as the investors do better and better, all designed to align the interests of the investors and the management team.
And just one thing to note is that, again, we're talking about the vesting of stock options. It's not stock ownership, it's stock options. And in a private company, even when the options are vested, the employee does not own the stock. They could exercise to own the stock, but until such time as they do, they are not stockholders. If they do exercise, we often have it that they, as part of their exercise, they're agreeing to join onto the stockholder agreement or the equity holder agreement. But often in a private company, you don't see people exercising their options, but they're very valuable to that person because they truly own the spread between the exercise price and the current value times the number of options. But it's a way that they have the feeling of ownership without actually owning it. And if they did own it, they'd end up in a situation where they'd have to pay taxes. And so that's one of the reasons that you often don't see share ownership exercise options before a liquidity event or an IPO.
Right, and that plays out a little bit differently in a limited liability company that is a tax pass-through, because if that entity is issuing profits interest as its form of incentive equity, then those recipients actually do own the equity. And yet, if they fail to vest into that equity, the company effectively can repurchase it for a de minimis price. So it's ultimately the same type of structure, but with some nuances depending on the type of company you have.
And I guess one of the things to think about is that to the extent an employee does not vest, that those options actually go back into the pool of options for the company, and the company could reissue those to somebody else, so that employee leaves even though they had received an option grant of 500 options. Those go back into the pool. They don't stay with the employee, and the company is free to issue those to somebody else or grant those to somebody else.